I've spent 50 years on Wall Street, and I've never seen anything like this. Goldman Sachs says that AI will create $7 trillion in new wealth, making it more lucrative than the smartphone, the personal computer, and 5G combined. But with all this opportunity comes risk. Just like with the dot-com boom, people will get burned, which is why I'm coming forward today. Today, I want to use my 50-plus years of Wall Street experience to make sure that you're positioned correctly for the AI boom. More than that, I want to show you how to invest in the AI stocks that Wall Street is going all in on, including my #1 personal pick.
Hi, this is Daniela Cambone, and welcome back to the summer series here on the Daniela Cambone Show on Stansberry Research. Well, as summer comes to a close, it's almost only a few weeks left, folks. What happens when the S&P is 10% or better year to date? How should we be positioning ourselves? So we've brought back fan favorite Carter Braxton Worth of CNBC's Chartmaster. He's also the founder of Worth Charting. Carter, always good to see you.
Thank you.
I'm also excited because I asked you to bring me the chart of the summer, so I can't wait to see what you have in store. But first and foremost, how have you been?
Good. It's all good. Sort of summer is always a nice time, and a little bit of less work, so to speak, a little bit more family, but always working. And but thank you, and I'm sure it's going well for you guys as well.
So far, so good, but let's get down to business now. What do we do with the S&P? I mean, midway through the year here, we kind of fell asleep at the wheels a bit, and you're on vacation, but come September, and with the, if the S&P is 10% or better, how should we be positioning? What do you see in store here?
Sure. So there's so many ways to, and it's always in the eye of the practitioner. You know, there are at any given time strategists, economists, top-down players who are bearish, who are bullish. One thing we know that momentum is a very powerful force, both to the downside and the upside, and relative strength also, good relative strength or poor relative strength. In fact, if you look at all the factors that go into many quant models, the two that have the most robust sort of history to them in terms of generating alpha, it's momentum and relative strength. So while it's tempting, and I try to do it maybe too much to fade something that's strong, all the statistics show that when something is strong, you're right to respect the strength. Now, at some point, of course, it's overdone. That's when overbought condition is. It's overloved, it's overowned, or it's overpriced, right? Things get expensive. And my hunch is, of course, that's the circumstance for the whole market. We shall see. But if you do look at studies similar to what you've referred to, when you're up this much at the mid-year point, when you're this far above a low that was a bear market low, it typically, history reveals, continues. Now, each time is a little bit different. That's what the stats say. I'm inclined to generally not have a positive view here, regardless of what the momentum and relative strength studies show.
Are there certain levels that you're looking at, Carter, that we should be paying attention to?
I mean, one thing, the whole point of using moving averages, and think about it, a moving average, and we'll look at some charts in a second, a moving average is just an automated trend line, right? Trend lines can be drawn, and they are, or we automate the process with a moving average, short-term 50-day or longer-term 150 or 200. But if you look at where the S&P itself is in relation to the 150-day moving average, it's steep, it's uncorrected, and that is the risk. That, and if you think about, let me say it this way: the etymology of the word correction, just right in the word, it implies that something's incorrect. That's definitional. So that if you're bearish here, you are wanting, anticipating, thinking that we're going to have some sell-off. So whether you call it a correction, a sell-off, a dip, a decline, a drawdown, a drop, it's not a bad thing. It's a good thing. It corrects something that's incorrect, steep and uncorrected. And if you're bullish, you really would want one of those too, whatever nomenclature one prefers, because that's what sets you up ultimately to go higher. So that it's all about sequencing. And if you look at the sequencing since the October low, we're due for, again, choose your word, some sort of sell-off or drawdown, typically 7, 8, 12%. These are garden variety kind of things. We can look at a chart of the S&P if that's productive. All right, let's see what we've got here. So this is the 2-year chart, and this is the very well-defined sort of channel that we've been ascending in since the October low some 10 months ago. Those are mathematically parallel lines, and it's not out of nowhere or random that we've reached the upper band here and we're starting to struggle. We've hit our heads, if you will. Now, I would give you this same chart there with the channel, without the channel. These are, in red, unfilled gaps. So the solid horizontal blue line, those lines were dotted red lines, but those gaps have been filled. Now, the impetuous nature of the buying since March is such that we have 6, 7 unfilled gaps below. The lowest comes into play at 39.80, and that's about 11, 12% from where we're trading now. I think ultimately those will be filled, and that would be, if you think about it, a garden variety, sell-off, dip, decline, drop, correction. So put them all together, those three anyway. I think that's a pretty good roadmap, or at least one should have it on their corkboard above their desk, and that's what I'm thinking.
I know you've said it that you don't really look at the macro picture. I mean, you're a tech guy, but I mean, were you surprised that the Fitch downgrade of the U.S. Didn't hit the S&P harder?
Well, remember, I guess the U.S. got a downgrade from the other big rating agency, Standard & Poor's, I guess 10 years ago, right? They were downgraded from AAA. And I think that's an academic kind of thing. Yes, it does have some change in costs and borrowing and also implications. Yeah. But at the end of the day, I mean, remember, these are people, no pun intended, who I have my glasses on here. These rating agencies are people who couldn't find their glasses in '08. We're sinking, and they literally weren't downgrading anything until we got down to the '09 lows.
That's right.
And then they downgrade everything, you know. So these are not market practitioners. There's no money on the line. They're academics.
Well said, Carter. You know, if we look at some stocks specifically, I'd love for you to pull up Nvidia for us, just because of, you know.
Yeah. Well,
there's been so much buzz around AI stocks and how it's keeping everything afloat. So, what is one to do with a stock like Nvidia?
Yeah,
here?
this is quite extraordinary. Here's an Nvidia chart. You can see it now. So we have this important breakout, right, from a former high. If I made that longer term, you could say there's a 3-year chart. Quite often, after breaking out, you will fall back to the level from which you broke out. And so I think one has to consider that as a distinct possibility. Watch, I'll draw some lines here, that we are going to check back to or close to or even fill the gap from the earnings beat and the surge in May. I would point out that this is as loved as Cisco was loved. And I don't know if we have it here. Maybe someone who's in the office can drive. I have the Cisco annual report, a picture of it in 1999. And literally the title of the report was Feel the Momentum or something. Here it is. This is incredible. 1999. It just has one thing on the cover. Capture the momentum. Cisco has never gone back to that level. Watch this.
I love when you do this, Carter, by the way, when you bring
it's crazy, right?
Back to the past.
1990. Let's see if we can do it. So Cisco, look at that. Cisco's peak was $82. The stock's trading at $52 right now. So adjusted for inflation, it's lost about 85% of its value. And those guys put on their annual report, capture the momentum at the top. So here's the question. It was said at the time, right, that you can't have the internet without Cisco, right? That Cisco runs the internet. And because of their large market share in the router space, they still are one of the biggest, but the stock is nowhere. Guess what they're saying now about Nvidia? You can't have AI without Nvidia. This is hysterical almost. Let's do one other thing, and team, while we, Please. Here we go. So watch this. Let me just show you. This is a ratio chart. It depicts the relative strength. It's simply one thing divided by another, right? So we're looking at the semiconductors divided by the S&P, which gives us one line, and it's what a relative strength line is. It's not about the y-axis. It's simply about the direction. If this brown line is going up, semis are outperforming. If it's going down, they're underperforming the market. So semis peaked, right, in 1999, and they've not yet recouped all of their losses to the S&P. And then worse, here's semis to the S&P technology sector, So that's compared to Microsoft or Apple. And then even worse, look at this. Here's semi's relative performance to the NASDAQ 100. It peaked in 1994, just 1 year after they introduced the semiconductor index in the first place. And now all of a sudden Nvidia is going to change the world.
Yeah.
I doubt.
Yeah.
I
no,
doubt
that,
it. Yeah.
It really helps, when people get carried away with these momentum trades to keep that perspective. But I guess, is there a momentum trade we should be watching that you actually think is legit and has legs?
Well, nothing that's steep, but there are catch-up trades. Maybe I would say that are obviously gold being one of them. Things that have lagged, but whose chart patterns are constructive and good. And I'm a buyer of gold here. Interestingly, we could look at, let's do this and see what comes up here. We'll do gold versus the S&P on a 1 year basis, just for fun. And we'll see, you're going to find that there's not that big a difference. Ready? This is a comparative chart. We'll put SPX on the top and we'll put gold, XAU, underneath.
So this is for all the folks who say gold is boring.
Gold is boring. Here you have factual. So, it kind of, the story paints itself. So all the hoopla and all the look what I did and look what you did. And here are two lines and they're the exact same level. Gold has kept up with the S&P on a 1 year basis. Like, what's the problem?
It's all about the narrative, people. It's all about the narrative, and there's that chart showing it.
And I didn't
right
touch
there.
it. This is my here. Michael Bloomberg's, is one of the best data and one of the richest men in the world. And here's his chart: August 2, 2022 to August 2, 2023. You see the colors, the lines. It is what it is.
Wow, and it's a buy for you here because people might say, "Well,
I think so." I mean, I'm ultimately in the camp that I think rates have peaked. We shall see. But anyway, let's look at a gold chart. This is a recent gold chart, and we have this sort of bottoming formation. The downtrend line in effect since the peak, we're above that. I think you put it together like this. If you do a longer term, these lines draw themselves in many ways. Whether you do that, whether you do that, the drawdown was 8%. It was no different than the 8% drawdown in March. Or the more fun one, the long term. Are we ultimately, is this good reaction? You get to a former high, you contend with it before exceeding it. And so, to my eye, this is set up to ultimately and importantly move comfortably above the 2010, 2011 highs. And look, you could draw,
Carter,
please.
Yeah, please.
You could do it that way. You could do it that way. You could do it that way. The point is, here's silver. I think silver. Silver. This is the all-time high. Hunt Brothers, corner of the market. We get right back there. Talk about a double top. But I like how this sets up. I think one wants to have this very much as part of their mix in terms of risk assets.
So I guess to round up this beautiful summation you've brought to us today, Carter, I guess if you had to choose a chart of the summer for us here, for the summer series, one thing to watch.
Yes. I guess I would go with silver. That's the most exciting and most dynamic. That and/or those three relative performance charts of semis. I mean, semis are still below where they were in 1999.
Carter Braxton Worth, thank you for this roundup. Thank you for joining us for the summer series.
Thank you, team. Bye. Thank you, Danielle.
And thank you for watching. We'll have more great content coming your way, so be sure to stay tuned. And don't forget to sign up at danielacambone.com.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.